All right, I just hit the record button. Looks like it's 9 o'clock on the East Coast, so let's go ahead and get started. My name is Brian Kahn, and I will be holding this webinar for about 45 minutes this evening. As you can see, the title is Back to Basics, Trading in This New Economy. We'll be focusing on your account. We'll go over a little bit of technical analysis, and then we'll introduce a piece of technical analysis looking at Fibonacci retracements, one of our very favorite technical indicators out there. So down below you have my name, you have my boutique investment consulting firm, I guess you could say, Jupiter Peak Financial, where I do educate traders, basically, as I say, one step at a time, looking at who that trader is, and then going into what they can handle as far as trading time frames, account sizes, risk tolerance, things like that. You have my email, and then you have my blog, which we'll go to in just a moment anyways and throughout the session. But that's where I write some daily market commentary, and I did go ahead and update that today with some of the interbank charts as well as some of the interrelationship opportunities that I usually talk about and focus on. So let's quickly just take a look at some of that support that's out there for you. So right away, again, I mentioned that I would take you to the blog, so let's just go there. We're kind of going to one of the last slides first, but let's just take care of that so you can see financebanter.com. Again, that's a free blog. You don't have to log into it or anything like that. And then the category is under Forex, so the Forex section there is just the third one over from the right, and then you'll see my commentary, which I call the Locals Take, and I updated it actually a couple times today talking about gold, as well as just the regular market commentary today. Other education that's out there, obviously on Interbank FX, they have education, they have tools, and they also have a YouTube site. And so if you weren't able to catch the first video, these are kind of based on a series that I'm doing. So this is the second one that I've done with Interbank FX. So this is the first one. So you can just go to YouTube and then Google Interbank FX Back to Basics, and you'll see the webinar from 2 weeks ago. I want this to be interactive, so if you do have questions, I will check the monitor here and there as far as any chat functions, so please go ahead and chat in. That would be great. And again, I want to make it interactive and make sure you're getting a lot out of this and that we can maybe talk about a specific situation that you've come across. So back to the PowerPoint here. Again, we'll use these slides basically generically, and then they'll take us into the financial markets basically. All right, so just a quick disclaimer. I want to get this out of the way. And this disclaimer is more than just, reading these words. It really makes you think about what you're trading, which is a leveraged product in foreign currency case, as well as some of the other markets that we'll talk about, the options markets as well. So the bottom line is if you don't have a trading plan, then obviously it could be a recipe for disaster. So that's one thing that Jupiter Peak Financial does concentrate on a lot, is making sure that you guys have trading plans that fits, again, who you are as an individual. All right, so the outline for this evening, we're going to touch on fundamental analysis, as we always do. Then we'll get into account risk and trade risk. Again, there's an equation that proves you have a trading plan. So again, I'm hammering here on trading plans. There's a couple steps that ensures us of having a trading plan, and that is going through account risk and trade risk. Then we'll go into technical analysis, talking about three key terms: trend, support, and resistance. I tell a lot of my students and my clients out there that if you know these three key words, not only can they keep you out of a lot of trouble, but they can make you money. So what understanding the trend and the support and resistance does for your trading, it basically cuts out a lot of the poor 50-50 type trades where you're risking one to make one, or risking two to make one. Understanding where people are buying and where people are selling is really, really of key importance when you're looking at the financial markets. We'll then get into Fibonacci retracements. I love the Fibonacci retracements because it tells me where I am now versus where I just was. So it kind of gives me a place in space, a place in all of these markets. They're moving very rapidly, but Fibonacci retracements really give me an idea of where I'm at. And then we'll do a quick review and then what's next. So fundamental analysis, let's talk about what's happened over the past couple weeks. We'll go into forexfactory.com. Again, if you went into Interbank FX, you would see that there is a link basically under their tools, and then you go to online tools to the economic calendar. That brings up basically our Forex Factory, which is a third-party website, the economic calendar. So I already have it preloaded up, but I just wanted you to see that if I click on it, what it does is it loads here. It loads one day at a time here on Interbank FX, and as we're kind of covering 2 weeks of data, I want to make sure that you guys are able to see that. So we're going to leave the site that Interbank FX takes us to really quickly. If you clicked on any of this stuff, it would take you there, but like I said, I have it preloaded. So here we are at forexfactory.com. And again, what this is just telling us what's going on around the world as far as economic data being released in various zones, Eurozone in Great Britain, Japan, Australia, New Zealand, Canada, United States. So today we had some data. The United States, we had retail sales. So basically came in a little bit under expectations for the most part, but still for the most part positive, which is good. People are spending. I talked about that in one of the classes I taught last night, that I was flying and I had to go speak at a conference in Denver this past weekend, and the airport was crowded, bars and restaurants were crowded, so people are out there spending money. So I figure that any increase in commodity prices, gas prices, things like that, haven't impacted us just yet. Who knows if they will, but as of now it seems that people are still spending, and that's what we saw today. Tomorrow we have some interesting data. We have the G7 meetings going on, affecting all the different currencies, and possibly not. We also have in the United States, we have our initial unemployment claims. That's big, just to see how the job market is going, or jobless market is going, I guess you could say. And then on Friday we get some inflation data, the CPI, Consumer Price Index, how much you and I are paying for a basket of goods. And you know, Bernanke's been talking about this, and Bernanke sets the interest rate policy for the United States dollar, and he said if this proves to be more than transitory inflation, meaning it's sticking around, we may do something. So I don't think that anyone's scared by his words yet. I think we'd like to see action, because right after that he said, hey, we're going to keep rates low for an extended period of time. We know that other countries, including Europe, or other zones, have raised interest rates. So that's what we'll talk about over the next few weeks, tonight and the next few weeks, as we get into the charts, talking about moving averages in a couple weeks. So right there, a little hint at what's coming at you. 2 weeks we'll be talking about moving averages, and what great charts to look at moving averages on, since we are having great trends. So that's a quick look at the economic calendar. As far as the next few days, still a lot of busy action Thursday and Friday. Hopefully that will mean we have some good movement over on the market side, basically. So aside from Forex Factory, you can turn on CNBC, and any of the indicators that I just talked about, CPI, initial claims, retail sales, CNBC will be talking about them as they come out. So you don't have to stare at the computer screen. You can just say, hey, I did my homework, I know when things are coming out, and I'll turn on CNBC and make sure that I know what it came out as. Bloomberg TV and Bloomberg.com, again, the same thing. You can look at it online or get it on your TV station, but again, covering the markets. Your broker, I've already shown you where Interbank FX gives you a lot of online tools, a lot of online education, YouTube webinars that you can go back and review. So lots of good information from your broker. Maybe you have a broker for stocks and options, which we'll talk about as well today in those intermarket relationships. So they have the same kind of education as well. And then other market sites. The financial markets are huge right now. Lots of people are paying attention to it. So anything I bring up, anything you don't understand from tonight, or in the blog that you're looking at, that I'm writing about, or anything you hear about, reading about in an article or hearing about on CNBC, Google it. I'm sure that you'll be able to find an explanation from it. All right, let's go into talking about you as a trader. So this is, again, focusing on you as a trader and talking about trading plans. So before I get into it, I'm just going to check back and just make sure that we don't have any questions at this time. But again, this is where I do want you to be able to understand that this is about your account. So 2% rule, I mentioned this 2 weeks ago, and now we're going to get into it a little bit deeper. So let's just take an account, for example. Let's say that you have a $5,000 account. Well, what traders are looking to do is have small, consistent results over and over and over. So the 2% rule, what that means is that I'm risking 2% of my account on any one trade. So that's what I'm about to lose. Not what I'm investing in a trade, but what I'm about to lose. So let's say I have that $5,000 account. Well, 2% of that is going to be $100. That's it. All I can lose is $100. So if I put on a standard lot, then I know that basically 1 pip, the smallest increment, is going to be $10. So if I put on one contract, I could lose basically 10 pips basically, because it's $10. 10 times 10 is $100. That's it. So it'd be a very short-term intraday trade. If I wanted to risk a little bit more to make a little bit more, well then maybe I have to go down into what's called a mini, and that's where it's worth $1 per pip instead of $10 per pip. So you have standard contracts, one contract equals $10. You have minis, which are $1 per pip basically. So one contract is $1 per pip. So again, we'll see this as we look into some trading examples. So that's what I mean by 2% of what? Who are you as a trader? So I want to go into two examples down here. I want to go into a day trader who's short-term, and I want to go into a position trader who might be hedging some other larger position. Let's say you're using the Australian dollar, which is tied to gold prices, the Canadian dollar tied to oil prices, and these are these intermarket relationships that I talk about. Maybe you're using them to hedge some of your commodity holdings over in your equity or option portfolio. So let's go right into the markets then and take a look at what's going on today. Right now on the Interbank FX website, basically here on the MetaTrader 4 platform, I have everything on a daily chart. And what's interesting is this is why I've called this back to basics. We are seeing a lot of relationships break down. Look at what the pound versus the US dollar is doing. Very, very sideways. Look at what the euro is doing versus the US dollar. It's going to the moon. Look at the Australian dollar. Again, there's your commodities and gold prices and inflation going to the moon. New Zealand, kind of same part of the world, going to the moon. Flip things around, the US dollar is now the first currency. It's getting weaker against the Canadian dollar. And then you have the US and the Swissy, which has kind of been all over the place as of late. So let's just bring up the pound versus the US dollar. And actually, you know what? Let's go to the euro versus US dollar because there was some nice trading opportunities going in on that. And I'm going to shrink this down just so it's a 30-minute chart basically. All right. So again, I'm going to start to introduce Fibonacci's as well. And again, this will just be an overview of Fibonacci's, which we'll get into later on in more detail. But let's just look at this big move that we had up yesterday. This was the 12th of April. So yesterday we had a huge move up. And then in the middle of the day, basically, we had this retracement down. So which way is the trend going? The trend is going up. The trend is retraced, so counter trend, that's our retracement, and then it shoots back up and continues the trend. So maybe you chose to buy it down here. So let's see if we can kind of diagnose this and really take a look at it for account size. So if I have that basically $100 risk that I can have for a $5,000 account, well, I know I can only risk 10 pips basically if I'm doing standard lots. So what I'd need to do is if I choose to buy it, maybe I'm buying it down here, and again, this is all theoretical and just for educational purposes. I'm just making this up tonight because I just saw it pop up in front of me. Maybe you decided to buy it down here at the 61.8% retracement because you like that area, all right, and it bounced back up and went off it. Well, you only have 10 pips to risk. So if you're risking 10, you're trying to make 15 or 20. But the point is you have to see if this is too volatile, if 10 pips would shake you out. If that's the case with a $5,000 account, you may have to go down to trade half a contract or trade the minis, where you can risk 20 or 30 or 40 pips. And then you can put on 2 or 3 or 4 contracts, all right, which are worth $1 only in the mini. So you really have to understand who you are. So in intraday trade, if you're only risking 10 to 20 pips, that can happen in the blink of an eye. As we know, this thing went from 45.12 to 44.20, 44.30 basically, almost 70 to 80 pips within a very short time frame. And one 30-minute bar basically took it the bulk of that. So again, what you're saying is, as a shorter-term trader, I risk less to make less, but I've got to make sure that I have the right amount of risk for that trade. Is 10 pips enough to risk? Is 20 pips enough to risk? So every trade has a different scenario. Every trade might just be a little bit different. I'm willing to risk 15 pips because of the trend line. I'm willing to risk 20 pips because of the Fibonacci. I'm willing to risk 30 pips because I see this moving average. Whatever it may be, you've got to divide the amount of pips that you're willing to lose into your account risk. So if I'm willing to lose 20 pips, All right, I have a standard trader. Well, 20 pips basically times 10 bucks, that's $200. $200 divided into my account risk for my $5,000 account of $100 doesn't work. It's too big. I can't do it. So I've risked too many pips. Even though that's the right amount of pips for maybe that trade, I can't do that. So I might have had to go down to standard lots. So you have or to mini lots from standard lots. So again, what you're getting at is you're building a trading plan for that specific trade. Find out how many pips you need to risk. Then divide those number of pips into your account, into your total account risk, and then you can see how many contracts you can purchase. So maybe if you have a $10,000 account, now 2% of that is going to be $200. Now it might be okay to risk 10 or 20 pips. If you risk 10 pips, you could do 2 contracts. If you're risking 20 pips, you could do 1 contract. So again, that equation is very important. I talk about it a lot on my blog. So some of you, it might be new for you guys. If you have any questions, you know how to get a hold of me about via email. But it's really, really important that you understand that for every single trading scenario. Let's take this out and do the other scenario. Let's say that this is a hedge. And let's bring in the Australian dollar because it's a commodity that's roaring and roaring and roaring and roaring. So let's say that you have a lot of commodity stocks, maybe a lot of gold stocks in your portfolio, maybe even you're holding on to gold bullion under your mattress. Who knows? You may say, if the price of the Australian dollar goes up, that's good for my portfolio. If the price of this starts to change and there's less demand for it, or things change because Ben Bernanke wants to raise our interest rates because of inflation, let's just take Friday's inflationary data. Maybe the CPI gets really elevated on that Forex factory. It comes out elevated, and that causes people to be worried about inflation. Oh my God, Ben Bernanke's going to change his policy, and the dollar strengthens on those worries. So you know that if the dollar strengthens, that could hammer your commodity portfolio. That could hammer your gold portfolio. So what you may choose to be doing is you might say, maybe I have 20 or 30 or 40 or 50,000 or more in my foreign currency account, and I might not just trade for 10 or 20 pips. I might be risking 100 or 200 pips to make 300 or 400 or 500 pips in case the Australian dollar weakens due to the dollar strengthening due to inflation fears in the United States. So again, you have to adjust how big is your account, how much are you willing to risk, what is the big picture here? Are you trying to achieve a longer-term trade to protect a downfall in your commodity portfolio over in your equity and option markets, and how to do that? Well, I might say that I might see resistance up here at 105 roughly, and I might put my stop in at 106 or 107. Well, we know that if I put my stop in at 106, that's 100 pips away. So 100 pips times 1 contract, 1 standard lot of 10 bucks, that's $1,000 right there. How big is my account to risk $1,000? Maybe I do some minis where I'm only risking $1 per contract. So I put on 1 contract and I risk 100 pips. I risk $100. I put on 2 contracts. I risk 100 pips. I risk $200. Again, it all depends on what you're trying to achieve. The point is, these trading opportunities are out there for us. You just have to understand what you're trying to achieve and what the right risk is for that exact trade. Some of you may be trading short-term intraday trades, and you may also be doing longer-term swing, intermediate position type trading as well. All right. So again, if that's new for you guys and it's unclear, you know how to get a hold of me, and please let me know, and we can go over more examples. All right, so back to the slides then, and again, we'll try and build in this again as we get into a little bit more detail. So we talked about the 2% rule, 2% of what? Basically, 2% of what I'm trying to achieve out of this trade. So I'm risking 2% of my account, but every trade will be a little bit different. I'm risking 20 pips, 30 pips, 10 pips, 50 pips. It's all different. So I get my trade risk for that specific trade, and I divide that trade risk amount into my overall 2% rule of my account risk. So we went into the day trader and the position trader basically, or someone who's trying to hedge something. So again, technical analysis, now let's leave that equation behind, because once you have that equation, you have it forever and you understand how to do it. So it's really, really important. If you don't have it down, you don't want to be risking more than you should be for your account, because as you know, in a leveraged product, if it runs and runs and you have a couple losers, it's very, very dangerous to your account size. What are the traders doing with the fundamental news that we are seeing in the Forex factory calendar, that we're reading about on Bloomberg, that we're hearing about on CNBC, the stuff I talked about, Bernanke, CPI, retail sales, things like that. So we want to go into trend, support, and resistance. And what a great time to be looking at trend. What a great time in that pound US dollar example to be looking at support and resistance. So we have some really, really good examples. Again, as I said in the outline, these are very, very important technical analysis tools. The three most important out there, I think, that can make you a very, very safe, consistent trader. We'll talk about some live intermarket relationships, which basically I've already discussed with the Australian dollar and the Canadian dollar. So let's head back into the charts here, and let's do a trend. Let's go with trend first because that's so important to know. All right. Let's see here. Let's reset everything. So here's the Australian dollar. Big trend, 97 cents against the United States dollar to 105. It gained basically 8 pennies. Trend doesn't get much better than that. Again, as I said, in 2 weeks we'll be talking about moving averages. Moving averages work really well with trends. So there's a moving average on here. Don't pay too much attention to that. We're not discussing that tonight per se. But the trend is up. So who's winning, buyers or sellers? The only way for the price to increase is there's more buyers than sellers. The buyers are winning out. And you have these small little dips, and then it runs up, and a small little dip, and it runs up. So the way to make money in an uptrend is buy the dip in the uptrend and have it shoot up and make a new high. Buy the dip in an uptrend and have it make a new high. Let's shrink this down and see just some smaller data basically. So here it is on a much shorter time frame. Let's go down to a 1 hour. Now let's go to a 4 hour and see it. So here it is, your big up move, small down move. Big up move, small down move. Big up move, small down move. All right. So there's our correction in the Australian dollar. And now is it going to take off and head back up? Let's reset this again one more time. There we go. So there you have over and over big, big moves to the upside. So if we're going to have a higher prices in the Australian dollar, well, maybe you think that that takes the gold prices up, and there's those intermarket relationships, which we're going to talk about in just a second. So for this trend to continue, we need this to make a higher high. There's some significant resistance here right about 105.5, 105.60. As it comes back up there, is that give enough pause for people to start to sell, or does that give enough people pause for people to basically buy some protection, like I said, in that intermarket relationship? So here's the picture of the Australian dollar. It is closely related to prices basically over in the commodity that is gold. So what we're going to do is, as it loads up for you, let's take a quick look at what gold, the ETF that represents gold, is doing. All right, so we just entered Options Express, which is a stocks and options broker. And so let's take a look now. So you can see what's gold doing. It's heading up. It broke through this resistance line, this blue line right here, and then it had a little dip, and it headed back up. So again, that trend is up. Buying dips in that uptrend is the way to make money. We can't sell rallies really, really safely until we get really, really good locations. But again, we're going to be selling it for a very small profit because it's going down very small, then it turns around and makes a new high. We can't really sell something until we get a fundamental change in sentiment. Like I said, maybe Ben Bernanke says we're raising our rates from 1/4 point to 1%. Well, that would be probably a fundamental shift in maybe the way the commodity prices are going, because he's proactively taking care of finally maybe some inflation that's out there. So you're looking for a fundamental shift in policy. You're looking for a technical shift where you see a failure, where you see resistance coming in, something like that. So those are really, really good trends to see. Look at what gold prices are doing. Look at what the Australian dollar is doing. There's a really nice relationship there. Okay, going back and talking about those two other terms I mentioned, support and resistance. Those red lines are drawn on there for you. Let's shrink this down a little bit so we can see it. And we'll go back here. So look at what's going on here for the most part. Look at how many people are selling the pound right about 1.6250, let's just say. Yeah, it's peaked up there a little bit, it's peaked up there a little bit, peaked up there, but every time it comes right back down. Look at the buying. Look at the buying down here. Let's just round it to 1 point, maybe even 6000, a nice round number. Look at all the buying going there. So you tell me, would you rather buy the pound at 1.60 or 1.63? You want to buy it at 1.60 because your risk is less than your potential reward. Based on past performance, it moves 2 to 3 pennies. So is it okay to risk 1 penny, 1.5 pennies to make 2 to 3? That's a nice longer term trade. It happens over a week or so, where again you could risk 50 to 75 pips to make 200 to 300 if your account can handle it and you're doing the right trading risk for that specific trade. Intraday, there's a lot of movement going on up and down and up and down. For the most part, you can see today, look at the 12th of April and look at the 13th of April. Really volatile markets are really sideways markets. You have a range of basically 62.50 to 60, let's just say 63, 62.98, 63. So basically you have a 50 pip range for basically the better part of 2 days. A lot of action or a little bit of action, not too much. Even with the big sell-off yesterday, not big, but a sell-off, I guess you could say. Any sell-off in the equity market is big. If it's 5 points to the downside, that's a big sell-off. Really, there wasn't that much excitement overall in the pound. It's really staying in that range. Eventually, though, it will break out of that range, and we'll have something new in the charts. Will say, hey, you can't buy me at 1.60 and you can't sell me up at 1.63 because I'm breaking out to the upside and you're going to have your loss, or I'm breaking to the downside and you're going to have your loss if you bought it. But that gives us new information. Maybe fundamentally something's caused us to get to that new place. So again, for a long, long time, look at this. This is January and February and March and April. 4 months basically of really sideways action where the pound has been in a 3 or 4 pip range. So if you're trying to day trade that, you better be at the bottom, or swing trade of it. You better be at the bottom part of the range or the top part of the range, because in the middle there's a lot of fluff basically. So that's what support and resistance teaches you, whether you're looking at it on daily charts or whether you're looking at it intraday, as we saw. If we go back down to that 30-minute chart, you could maybe get away with buying it at 62.50 and maybe get away with selling the top up there at 62.90 or so, and understanding that until it breaks out above or below, it's in that range. Okay. Again, like I said, please ask away with any questions that you have, or if you want me to look at any pairs, we can bring those up. So just to touch on that inter-market relationship again, let's look at what the Canadian is doing. Here's the U.S. Canadian. Over time, the United States dollar is just losing value, 1.06 all the way down to where it's at right now, well below parity at 95 even. The past, basically this is a daily chart, so the past few days it started to peak up basically from 95 to 96, but very, very little. Again, here's a trend. Big move down, small move up, big move down, small move up, big move down, small move up, big move down, small move up. Who's making more money here, the sellers or the buyers? The sellers. They're understanding that other currencies have stronger interest rates. I think the Canadian right now is about 1.0 versus ours at 1/4. And again, as Bernanke said, hey, there's some inflation out there, but by the way, I'm going to keep rates low for an extended period of time. So again, there's just not much reason fundamentally or technically right now for the dollar to be gathering that much strength. So maybe this becomes a selling opportunity again down here. Based on past performance, there's no guarantees, but obviously that's where the way the trend is, and there's that old adage that the trend is your friend. Again, to touch on those intermarket relationships, let's just see over here in Options Express what oil prices are doing. So we can track basically oil prices with USO. And does USO look eerily similar to gold? There's that breakout basically above resistance right here, so I could draw a trend line right across. It gets above it. It actually uses it as some support eventually here. Old resistance becomes new support and launches off. Look at these relationships, you guys. Gold and oil are looking exactly the same. Canadian dollar against the U.S. dollar and the Australian dollar versus the U.S. dollar are looking exactly the same. That's why it's so important to understand the big picture out there, the macro events. That's what I'm talking about in my blog on a daily basis. That's what's going on in these webinars every couple weeks. There's some really, really good opportunities out there to be making money as long as you're understanding the big themes behind it. Then you can use the charts for your timing. You can use the charts to say when and where to do something. Hey, the pound's in a range. I know I can buy it at 1.60 and I can sell it short at 1.63. Based on past performance, that should be a high probability, low risk trade with no guarantees. That's why I have a trading plan. That's why I figure out how many pips I'm willing to risk and the account risk for my personal situation, whether it's a $5,000 account or $500,000 account. You guys have to do that homework first. But the charts are giving you really good clues for those high probability, low risk, high reward trading areas. All right, so we covered technical analysis. What are the traders doing with the fundamental news? We're seeing trends. We're seeing good examples of support and resistance. We talked about those, and we saw some really good intermarket relationships between the equity markets and what the dollar is doing versus other currencies. getting into Fibonacci retracements. All right, so now we're going to spend some time here. Again, this is one of my favorite indicators. It's a very, very popular one. That's what I'm sticking to, is the popular indicators out there. You want to be trading and using what other people are using. So why do I love Fibonacci retracements? Because they tell me where were we and where are we now. It's really, really important. Again, it tells me where I am in space. You can look at these charts and kind of get confused. Where are we? Well, just slowing down, looking at trend, looking at support, looking at retracement, understanding these, and then using some Fibonacci retracements if possible, it tells me where I'm at right now, and it helps to guide me as far as those high probability trading locations that I'm looking at. Again, there aren't any holy grails out there. I'll be going over a number of technical indicators, a number of different chart patterns, but this one can help you as far as just understanding where you are in space. That's why they're so crucial to a trader's toolbox, basically. All right, so let's move into the markets and take a look at them. So again, let's go back to the euro because that's such a good example. And I want to try and shrink this down basically and see if I can move this over a little bit. And let's see if we can bring this down even to a 15-minute chart. Perfect. All right. So we're going to see a lot of data. So again, let's just take this one day at a time. So here we are basically, and you have to remember I'm in mountain time. So I kind of go off of the midnight time frame. So I'm going to try and find midnight basically my time on the 12th. So here we are at roughly 6 in the morning because basically GMT is basically 6 hours ahead. So this would be 6 in the morning GMT time. So basically right around then that's my midnight time here over in Utah. And we have this major move up during the European session. We move from 1.4382 all the way up basically. That happens from midnight my time to roughly about 4 or 5 in the morning. All right, so not a lot of time basically to move that far. So we go from 43.80 to 45.15, so 130 pips or so. And then all of a sudden, the equity markets in the U.S. are starting to open. It's 2 o'clock GMT time, so basically that's about 8 o'clock in the morning my time, and the markets just open at 7:30 my time. So I let the markets open. I let them digest some of that economic calendar news, and I understand the trend was up during the European session. And here it comes barreling back down during the American session. Maybe it has to do with equity prices. Maybe it was an announcement. Who knows? And I'm going, holy cow, what a great discounted price. So the whole idea behind trading is we're trying to go ahead and get discounted prices, all right? Whether it's overbought and too rich or it's oversold and too basically poor, basically too much undervalued, that's what we're looking for. So what I'm looking for is a big move up followed by a retracement where I can get back on that trend at a discount. So as it starts to retrace, I would measure the move, and that's what makes trading fun and Fibonacci's fun is everybody's going to measure the move a little bit different. I try and find the genesis of the move, meaning the starting point of the move, and I try and find the end point of the move. So I drew a Fibonacci from the starting point of the move to the end point of the move, and we started retracing 23%, and then we retraced 38%, and then we retraced 50%, and then we retraced 62%. All of these are okay to trade. You just have to have your trading plan. Why are you picking the 23%? Why are you picking the 38%? Why are you picking the 50%? So I'm just using this as an example, again, because I saw this before we got on the call, and I wanted to go over Fibonacci's and what a perfect one to do. Is the 61.8% always going to work? Of course not. Is the 61.8% a holy grail? Of course not. It's just worked in this example. So if you said, I'm a 61.8% buyer, and I buy it here, and again, we have that price point of roughly 44.35, let's say, you put your limit order in at 44.35 or 36 or 35.5, whatever you want to do. And you now have to decide how many pips do you want to risk and where do you think it can go. Do you want to risk 10 to make 20? Do you want to risk 30 to make 60? It all depends on where you think it can go as you manage that trade and as your previous experiences picking up a discounted pair in a big trend. So the person who looked for the 61.8% level and only traded that level would have worked. The person who used the 23% level may have been stopped out. The person who used the 38% level may have been stopped out as it shot down. The person who used the 50% level may have been stopped down as it shoots down. what's nice about these Fibonacci, some traders will use the next Fibonacci level as their exit. So if I buy the 50% level, if it hangs in above the 61.8% level, I'm still in the trade. So this one may not have stopped me out if that was my rule. Again, this is what makes trading fun, is charting is an art, not a science, and everybody has different rules, okay? This is what I work with my clients, and I give them very, very specific places to trade in the beginning until they prove to me that they're reading the markets correctly and they're analyzing it correctly and giving a good trading plan. If you're having trouble with the markets, if you're not in good locations, that's something to think about. We didn't get stopped out because they got us. We got stopped out because we had a poor location. So that's what I work with, is making sure that people understand these basic concepts. And most importantly, what it does for a trader who's trading poorly is it cuts out 50 to 80% of their losses. If you could say, if you could say, what would 50 to 80% of your losses going away, what would that do to your P&L? That's what I try and work with my traders on, is saying, if you're a trader and you're not doing well, let's see. Show me some examples of what you're doing, when you're doing it, why you're doing it. If you're a new trader, well, you don't have any of these bad habits, and you just get to learn some really, really low-risk trading places. No guarantees we're going to make money, but if you lose money, it's going to be a small calculated loss, and you're in the game to trade the next day, the next week, the next month, whatever it may be. So this 61.8, again, whether you were a trader trading for 50 or 60 pips, or whether you're working for 5 to 10 or 15 pips, you guys may have used the same stop and only risked 10 or 15 pips basically to get that 5 or 10 or 15 pips, or only risk that 15 pips to make 30 or 40 or 50 pips. You may have gotten it for the same reason. You just were looking for a different outcome basically, but they would have been a good reason to get in using that level. So Fibonacci's are, again, a really, really strong tool because, like I said, they're not a guarantee, but what they do is they basically help you find out where you are in space. Am I getting on a trend at a discounted price? Absolutely, in the case of the euro. All right, that's a short intraday opportunity, basically. Trying to find one longer term, it's harder because the stock market's been rallying so much and the dollar's been getting crushed so much. It's harder to find it in a much longer term one. You can see there's not really any retracements. This little retracement here of this move is very small, and we just haven't retraced. Eventually, that's the whole point. Things will retrace, things will move, but you can't draw a Fibonacci retracement until things start to retrace. So this huge move up right here, we've retraced 0% of it basically because we're at the high. We've taken little dips there, but they're very, very, very small. So that's just something to remember, is the stock market is going so fast, and these pairs are going so fast that using Fibonacci's sometimes doesn't work, basically. Not doesn't work, it's just we can't use it because it's not happening at that point. I'll show you a good example of that in the S&P. Again, here's our intermarket relationships. The dollar is getting weak, 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 and let's look at what the overall stock market is doing. So here's the SPY, the Standard & Poor's, basically the ETF on it. So look what we've done. Let's just go out to a longer term chart. Look what we've done in the past 2.5 years. We went from 70 to 130. Any retracement we've had has been very, very small. Even this retracement right here, this big move down, is such a small retracement of the overall move up. This retracement right here, when Japan happened and we went from 134 to 125, still very, very small of a much bigger move. So if we bring it down to a 1-year chart and we see this move, if I draw a Fibonacci on here, and that's a nice thing, once I understand Fibonacci's and I use them well and they help me to trade, I can apply it to any market out there. So if I draw a Fibonacci, we only retrace roughly 23%. And this isn't even the huge move. This is a small move of the S&P over the past couple years. So this 23% is even smaller when looking at that grand scale in that 2 or 3 chart. But look what happened after 23%. We went like a rocket ship. If you didn't buy it when there was calamity over there in Japan, basically, and fortunately things are obviously getting better, but no one knew that. But if you didn't buy it when things were just, hitting the fan over there, then you didn't have a chance because things went up so fast. We went from 127 to 134 basically in 2 or 3 weeks without stopping. That's a $7 move. That's 6 or 7% right there in 3 weeks. Massive. What are you looking at up here now? Look at all this resistance. Let me bring this down into a smaller time frame, just on a 6-month time frame. Look at this resistance up here at 134, 135. Are we going to go through it? Well, our Federal Reserve policy says we're backing you up, stock market. You can keep going because we're going to have low interest rates. So the risk is still to the upside in the stock market, and that might still be the risk to the downside in the U.S. dollar, understanding that policy out there. So again, you have to make sure that you're understanding the macro themes out there, because the trend is your friend, and going against the trend, whether it's on a 5-minute chart or whether it's on a 6-month chart, can be really, really deadly to your trading account. All right, so that's a good introduction to Fibonacci retracement, seeing them work there. Like I said, I wish I could bring up some more. If I went into individual stocks, it'd probably be easier to see it, because they're moving. They're moving a lot more than foreign currencies are right now. Foreign currencies are trending, all right, but they're not retracing per se. They're moving. They're just not retracing that much. And you saw that the pound and U.S. dollar that I showed you, that intraday chart of the past 2 days, 30 to 50 to 80 pip ranges, not much retracements when you're only going 30 to 50 to 80 pips. But the stock market in certain sectors, like the commodity sector, is moving all over the place. So just to review, keep your eye on the big macro and micro events. Macro, Federal Reserve policy, interest rate changes, things like that. Micro events, what's affecting your sector, your currency pair, a little bit more micro, taking a look at that. Account and trade risk, making sure that you're developing a trading plan for you as an individual, something that fits your account size, your account risk, and the type of trader you're doing. If you don't understand what kind of trader you are, day or swing or intermediate or position, then it's very hard to risk the right amount of pips. That's, again, something that I do with my clients through an engagement interview, is I really find out who they are, and I basically cut them down and say, this is who you are, this is what you can achieve with your lifestyle, with your time frame, family commitments, work commitments, and this is what you can achieve. And if you try and do everything else, great, good luck, but it's probably not going to work out if you're trying to force the issue. If you want to be a day trader and you have a full 9 to 5 hour job and your boss is staring at you, you're probably going to get fired and have all the time to day trade that you want. So it's not going to work out if you want to keep your job. Technical analysis, we talked about the 3 keys: trend, support, and resistance. We obviously have focused a lot on intermarket relationships, providing trading edges, and then Fibonacci relationships, obviously. And actually, there's a really good example of Fibonacci relationships. I focus on the energy sector and alternative energy sector. So let me just show you one that was really, really helpful when I was using those Fibonacci's. We're going to look at FSLR, First Solar. Okay, so basically what happened here, and I already have it drawn on because I've been using it, but I'll delete it and we'll redraw it. So we had this big up move, we had this down move, and again, any move that you see, depending on your time frame, you can draw a Fibonacci on. So what I was looking at is going, wow, that's a huge up move. Wow, that's a pretty big down move, and I'd like this to continue and go higher, but First Solar isn't doing exactly what the other markets are doing in commodity markets and things like that. Remember, it's its own entity. What micro factors are you looking at? So if I draw my Fibonacci from the high of this move down to the low of the move, roughly, it came flying down and it came flying back up. Oh, I've gone too far. Think about it percentage-wise. 136 to 160, that's a $24 move. That's 15% right there in just in a month. That's a big move. And then it ran out of steam up here. So the person who was using Fibonacci's to maybe get in, it paused here, came back down, paused up here. Maybe they used a double top. Maybe there's a moving average thrown in there. Again, these aren't holy grail things. These are basically you understanding the entity you're trading, whether it's a currency pair, whether it's a stock, whether it's an index, whatever it may be, and then using the technical analysis to time that trade. So before we wrap up here with about a minute to go, let's see if we can find out one other good example in Interbank FX, in the Forex markets, of some retracements. And again, so basically if we look at the US dollar Canadian, we know which way the trend has been. We know that commodity prices, or I guess I could say oil prices, have gone from 111 to 110 to 109, 108, kind of 107, 106 in that area. And that makes sense then. The past week on this daily chart, we've got some green bars. The U.S. dollar has actually climbed back a little bit. So let's see what's going on here on a smaller term, on smaller time frame. So as it starts to work its way up, as oil prices are coming down, as the dollar is getting a little bit stronger, your big moves are up, your smaller moves are down. But again, this is a tough one. Like I said, it's really, really tough and choppy to see good, clean Fibonacci retracements. And a lot of these are going from day to day, not just intraday. So it's harder to find. Like I said, I wish I could find some more on some of these currency pairs. But like I said, it's just the state of the markets right now. They're really, really, really trending, and it's hard to see any retracements. We know the euro has been trending like crazy, now starting to kind of show some signs of resistance. I'm not saying it's topping out, but it is resisted there. So tough place to find some. Again, 2 weeks from now, as we're going over moving averages, maybe things aren't trending anymore and we're starting to move all around and have some retracements, and we'll have to talk about retracements when we're supposed to be talking about moving averages. But I think that in the next 2 weeks, things probably will still be pretty much the same. Good economic news. We obviously have earnings out there that can affect stock markets and things like that. So we do have some stuff out there, but for the time being, it seems like the markets are pretty in a good place. That could change tomorrow, but that's what makes trading fun, is we get up and every single day is different. So just wrapping up, the next webinar is going to be on the 27th, 2 weeks from today, same time, same channel. We will talk about fundamental analysis, what's happened in the next 2 weeks. We'll go over technical analysis, bringing in again, key terms like trend, support, and resistance, the intermarket relationships, which I think are so important, and they provide so many good opportunities. And again, I'll introduce those moving averages. So again, some of that education that I showed you at the very beginning before the disclaimer, you can go into the Interbank FX, into their education section, good daily trading edges, things like that. You can go to the YouTube website and just go ahead and search for Interbank FX. You can go into, again, their education component has a bunch of different areas in there. And again, my blog, financebanter.com, in the Forex category. Again, I'm trying to update exactly what we went over today, talking about psychology and trading plans, talking about technical analysis, talking about macro fundamental analysis, all this stuff. So it's a way for you to stay on top of things day to day to day by reading that blog. Again, I'll just kind of flip back to the very beginning. Some of you I'm working with, some of you obviously are new and have never heard from me before, so try and catch up the webinar from a couple weeks ago on YouTube. That'll kind of introduce you to some of the topics we talked about today. But that is my email. Obviously, any of you are welcome to email me if you have any questions. So thanks for sticking around tonight. Have a great evening. I look forward to speaking with you guys in 2 weeks and talking to you if you have any questions between now and then. Thanks a lot.